Welcome back to the second part of our deep dive into money and banking. In part one, we built the framework, the monetary base, the money multiplier, and the formula that links the small base controlled by the central bank to the much larger money supply that drives spending and inflation. Now we turn to a related but distinct question. How do central banks actually influence the money supply in practice? And what role does the reserve buffer, the cushion of extra reserves that commercial banks voluntarily hold above the legal minimum, play in this story? By the end of this video, you will understand the three classic central bank policy tools, why the reserve buffer has exploded since 2008, what that explosion did to the money multiplier, and why modern central banks operate in a completely different regime from the one your textbook describes. This is the missing chapter between abstract money theory and real monetary policy. Section 1. Why central banks care about reserves. Reserves are the deposits that commercial banks hold at the central bank. They are the cash equivalent of the banking system, instantly available, perfectly safe, and the only way banks can settle large transfers with each other. The central bank cares about reserves for two interconnected reasons. First, the level of reserves is the central bank's main lever over the broader money supply. Every shekel of reserves the central bank creates can support multiple shekels of bank deposits, by the multiplier we derived in part 1. Second, the price of reserves, which is the overnight interbank interest rate, is the key benchmark for every other interest rate in the economy. Mortgage rates, business loan rates, government bond yields, even the value of the currency in the foreign exchange market, they all anchor to the rate at which banks lend reserves to each other overnight. Control the supply of reserves, and you control the interest rate. Control the interest rate, and you control the entire structure of borrowing and saving in the economy. Section 2. Required reserves versus excess reserves. Within the total reserves a bank holds at the central bank, we need to draw a critical distinction. Required reserves are the minimum amount that the central bank legally mandates the bank hold against its deposit liabilities. If the reserve requirement is 10% and the bank has $1 billion in deposits, it must hold at least $100 million in reserves. Excess reserves are everything the bank holds above that minimum. Excess reserves are the reserve buffer, the cushion. Why would a profit-seeking bank ever hold excess reserves? In normal times, very little. Excess reserves earn nothing or almost nothing, while the same money lent out could earn the loan interest rate. So historically, excess reserves have been close to zero, and the bank operates right up against the legal minimum. But after 2008, the picture changed completely. Excess reserves in major economies went from tens of billions to trillions, almost overnight. Understanding why is central to understanding modern monetary policy. Section 3. Tool 1. The reserve requirement. The first classic central bank tool is the reserve requirement itself. By changing the legally mandated reserve ratio, the central bank directly changes the money multiplier. Recall the formula from part 1. The multiplier equals 1 plus C divided by C plus R. If the central bank lowers R, the multiplier rises and the same monetary base supports more deposits and more money supply. If the central bank raises R, the multiplier falls and money supply contracts even with no change in the base. The effect is mechanical and immediate. Sounds powerful, and on paper it is. In practice, modern central banks rarely use this tool. Why? Because changes to the reserve requirement are blunt. They hit every bank in the same way regardless of their specific situation, and they can create operational chaos if banks have to suddenly find more reserves or invest less. The reserve requirement is the heaviest tool in the toolbox, and central banks today prefer to leave it alone. Section 4. Tool 2. Open market operations. The workhorse tool of modern central banking is open market operations, abbreviated OMO. The central bank goes into the bond market every day and either buys or sells government securities. When the central bank buys a bond from a commercial bank, it pays for that bond by crediting the bank's reserve account at the central bank. New reserves come into existence, literally created with a keyboard. The monetary base expands. When the central bank sells a bond, the reserves flow back and the base contracts. By calibrating purchases and sales every day, the central bank steers the overall supply of reserves and therefore the overnight interest rate to its target. This is how the policy rate is actually implemented in practice. Open market operations are surgical, reversible, and constant. They are the central bank's daily breath. Section 5. Tool 3. The discount rate. The third classic tool is the discount rate, also called the lending facility or lender of last resort rate. This is the interest rate at which the central bank lends reserves directly to commercial banks who cannot or will not borrow from each other. In normal times, this facility is rarely used. Interbank borrowing is cheaper. But during crises, the discount facility becomes critical. It provides a safety valve, ensuring that any solvent bank facing a temporary liquidity shortage can always get reserves. The discount rate also sets a ceiling on the overnight interbank rate, because no bank would borrow from another bank at a higher rate than it could borrow from the central bank. Together with the deposit rate paid on excess reserves, the discount rate forms what central bankers call the corridor, the band within which the policy rate operates. Section 6. The 2008 explosion in excess reserves. Now to the dramatic story of the past 15 years. Before 2008, excess reserves in the United States banking system were typically $2 billion. By the end of 2014, they were $2.6 trillion. That is more than a 1,000-fold increase. What happened? The Federal Reserve, facing the worst financial crisis since the 1930s, began purchasing massive quantities of government bonds and mortgage-backed securities, the program called quantitative easing, or QE. Each purchase injected new reserves into the banking system, but the banks did not lend those reserves out. The economy was in deep recession, borrower demand had collapsed, loan losses were piling up. Banks chose to park the new reserves at the Fed and earn a small but safe deposit rate. The same story played out in the European Central Bank, the Bank of England, the Bank of Japan, and ultimately the Bank of Israel. The reserve buffer became enormous. Section 7. What the buffer did to the money multiplier. Recall the multiplier formula 1 plus C over C plus R. When excess reserves pile up, R is actually held by the banks rises far above the legal minimum. The multiplier falls. In the United States, the M1 multiplier collapsed from roughly 1.6 in 2007 to under 1 in 2009, where it stayed for years. The monetary base had been multiplied by 5, but the broad money supply only grew by about 50% over the same period. The textbook money multiplier, the one we derived in Part 1, broke down completely. This is not a failure of the theory. The theory predicts exactly this outcome when R is allowed to vary. The lesson is that the multiplier is not a constant of nature. It depends on bank behavior, and bank behavior depends on the macroeconomic environment. In a deep recession, banks hoard reserves regardless of how much the central bank creates. Section 8. The new monetary policy regime. The 2008 episode permanently changed how central banks operate. Before 2008, central banks kept the supply of reserves scarce. Banks held essentially zero excess reserves. The multiplier was stable and predictable, and the policy rate was set by adjusting the marginal supply of reserves through small daily OMO. After 2008, reserves are abundant. The corridor system was largely replaced by a floor system, where the central bank pays interest on excess reserves and uses that deposit rate directly as the policy rate. Open market operations now happen at a much larger scale and serve different purposes, managing the size of the central bank balance sheet rather than fine-tuning the daily rate. The Bank of Israel adopted similar tools during and after the COVID period. The result is that the simple textbook story, central bank changes base, multiplier delivers money supply delivers inflation, has been replaced by a more complex framework in which the central bank works through interest rates, financial conditions, and forward guidance, with the multiplier acting more like a passive output than an active lever. Conclusion. We have now closed the loop. In Part 1, we built the money creation cascade and derived the multiplier. In this video, we have seen how central banks actually try to influence money supply in practice. They have three classic tools: the reserve requirement, open market operations, and the discount rate, and they use them to control the supply of reserves and therefore the policy interest rate. The reserve buffer, excess reserves above the legal minimum. is a critical variable that historically was near zero but exploded after 2008 because of quantitative easing in a crisis economy. That buffer broke the traditional multiplier and forced central banks to switch to a new operating regime built around abundant reserves and interest paid on excess. Understanding both halves of the picture, money creation by commercial banks and money control by central banks, gives you the complete plumbing of modern monetary policy. If you found this video useful, please share it with anyone studying macroeconomics or finance. And subscribe to Macroeconomics with Michael for many more deep dives like this one.